Okay, so we're going to get started. If everybody would take your seats, our feature presentation, pension de-risking, legislative and policy issues. We have a very esteemed panel. I'm proud to be part of all this. Marty, would you come on up here and sit with the real live panelists? So we've got Marty Leary coming up right now from Unite Here. He's going to sit next to me on the panel. And then we have two remote panelists. Karen Friedman from the Pension Rights Center. Hi, Karen. And
hi, everybody.
Steve Pilger from Brokerage. I'm going to ask all the panelists to just start off by saying a little bit about who you are and what your background is. Not too long, and then we'll take it from there. So, Karen, why don't you go first?
Okay, hi, everybody. A lot of you, I'm sure, know me. I'm Karen Friedman. I'm the executive director of the Pension Rights Center. We're a 47-year-old, it's aging me too, a 47-year-old consumer rights organization that works to protect and promote the retirement security of workers, retirees, and their families. We've worked with the BellTel Retirees, with Eddie, for years and years on lots of issues. We've been involved in the de-risking issue probably since 2012, when we first heard about GM's de-risking, and also when Verizon was doing it. So we worked on a bunch of issues, and I look forward to the panel today.
Thank you, Karen.
Good morning, everyone. I'm Steve Pilger. I'm with Brokerage, which is an insurance brokering firm based in Indiana. I'm coming to you from Phoenix, Arizona today, so good morning. My role with Brokerage is to help business owners, pension plan sponsors evaluate and in some cases reduce or eliminate pension plan risk from their books utilizing top-rated group insurance companies. So my guess is today is going to be a very good discussion, and I'm happy to be here. To give you a little bit of background, 35 years of financial services experience, and the last 12, I guess. 2011 was the first pension risk transfer transaction that we completed.
Thank you very much. Marty? Yep.
Can you hear me? I'm Marty Leary. I'm the research director and vice president of Unite Here, which is the hospitality workers union in U.S. and Canada. And when I was late in getting my biography to Samantha, and she said she was just going to use my Twitter handle, and I was panicked because I had no idea what I had put on my Twitter handle. But it's pretty close to a description. But I've been with Unite Here for 28 years, and believe it or not, I have been on this issue. For me, the issue is private equity moving into asset management of retiree pensions through many different avenues. I've been on this issue since even before that. In my previous job with the Southern Finance Project down in North Carolina, where we did some research and testifying around the executive life failure. And I didn't know Eddie at the time, but we were both kind of working that issue and from different angles.
Right.
So I'm really pleased to be here, and thanks for the invitation.
No, and thank you, Marty. I have collaborated with all of you in one way or another about pension de-risking, sometimes called pension risk transfer, sometimes referred to as PRT, all different ways to talk about, from the retiree perspective, a defined benefit plan sponsor, kicking people out of the plan and putting them into usually a allocated group annuity contract. And so when I first got involved in dealing with this issue, as I mentioned at the outset of this roundtable, was exactly what Karen Friedman mentioned, was when Verizon decided to kick 41,000 people out of their defined benefit, 41,000 out of the defined benefit plan, and all of a sudden they became certificate holders in an annuity contract that was issued by the Prudential Life Insurance Company of America. And so we started looking into what happens. And, what I was able to explain to the retirees, to the BellTel retirees at the time, which led to a lawsuit which went all the way to the Supreme Court of the United States, was that you lose a lot from the retiree's perspective when they transfer your risk to an insurance company. Now, what you'll hear from some of the panelists is if you transfer the risk and the insurance company does right by the pensioners, who then become certificate holders, it might not make a material change in your lifetime. You may get the payments that you expected. You'll never get a cost of living increase, but as you guys know, that's kind of been a thing of the past anyhow. But you should get all your payments, but you do lose a lot. No more annual statements. Creditor protections are uneven. You no longer have the PBGC backstopping. You default to non-uniform state laws. And state laws, I can tell you from a lot of experience, are non-uniform, and that can be problematic. In some states, 100% of your annuity would be protected. In other states, none of it. So that's something that I think is very little kind of understood, and I hope that we can talk a little bit about those issues today. But in talking with all of you, one of the issues that Marty mentioned was private equity getting involved in the insurance business. And that is something that we have been very active in looking at and monitoring because there are some real concerns. Private equity funds are not known for looking after policyholder interests. They're just not. The model is take in money, invest that money for a short period of time, short from a pensioner standpoint, and then harvest. Harvest by sale or harvest by some other financial transaction. But that, in my mind, is inconsistent with what a pension is supposed to be all about. And what do you think about that, Marty?
Yeah, I totally agree with that statement. I think it's, I think there's a kind of an interesting historical irony here that I think tells the whole story, which is, you've all heard of Apollo Global Management, the big private equity firm. Does anybody know how they started, how Apollo was originally created?
Yeah, it
I
was
know
out of the
you
ashes of
can't
executive. I'm not
you
allowed to
can't
answer.
play. You're not. You're yeah.
Sorry.
Anybody else know? He just said it. That's the ashes of executive life. I remember I was, working on a report way back on the failure. Like, who are these people? Apollo, Leon, and who they were they were former Mike Milken acolytes, right? Drexel, Burnham, Lambert. They're the ones who had, to put it bluntly, created the problem. They were among the architects of the executive life collapse,
Right.
and they knew what those junk bonds were worth, right? And so they put in a bid for the kind of carcass of the company, and they decided, and they went in with the California State Pension Fund, right? And those two investors decided to call the venture Apollo. And so CalPERS, the big California Pension Fund, was the original investor and partner of Apollo. Now Apollo is an insurance company. They have become one of the largest annuity companies on the planet, and they're just, and we can talk about that, we'll get to that later. But it's, to me, this is the direction we're moving, which is
Right.
that the insurance industry is essentially becoming a private equity playground.
Yeah, and I think what's really important, I know I'm not supposed to answer questions about executive life, but I spent a lot of time working through issues that policyholders had, and policyholders lost $920 million when Executive Life of New York was finally taken from rehabilitation into liquidation, and a lot of those were seniors. And that was a real big deal that kind of got swept under the rug. And what Marty mentioned was Executive Life of California was the first company to be taken over, and that was in California. They were placed into conservatorship, I believe, and lots of policyholders got hurt there too. Mm-hmm. Leon Black walked away with the entire bond portfolio that was yielding 11.5% at the time and netted more than $3 billion profit inside of a couple of years, and that's what led to Apollo. So this notion of grabbing these assets when they become distressed and then selling them when they suddenly become valuable, it's happened before and it's going to happen again. So that's something that we're looking at, very, very carefully. Karen, have you done any looking into kind of the private equity role in taking over pension obligations? You're muted. Karen, you're muted. You were muted.
I have to unmute.
Okay, good.
There we go. Hello, everybody. Well, I was just thinking while I was listening to you guys that back in the 1980s, we were really involved in the reversion issue. And that was when Michael Milken and those guys were terminating plants with surplus assets
Exactly.
and using those surplus assets to help take over. So we were very involved in that. And we have raised a lot of red flags, and we really want to work with you guys on this about Athene in particular, and Apollo, because there's been a lot of articles on that. So we've raised the issue quite a bit in terms of who are the new players coming into this de-risking area, and that there needs to be new regulation and potential legislation to protect participants in this, because I think it hasn't been studied enough. It certainly hasn't been publicized enough, and certainly both Congress and the regulatory agencies are behind the ball on this.
Right. That's super interesting, and yes, that is something we will work on because it's becoming a huge issue. Steve, I wonder what your thoughts are on about private equity firms getting involved in the insurance business, and how does that impact your choice of annuity provider when you're looking to help a defined benefit plan sponsor find an off-ramp? You're still on mute, Steve. I think you're still on mute, Steve. I can see the...
Left-hand button. You see the left-hand button?
It's a red microphone with a line through it. There you
I
go.
guess I needed permission to unmute myself, so I apologize for that. Whatever I had to say up to then, obviously is not going to be in the transcript. Eddie, no, yes, from my perspective, and I guess more from the distribution side, the front end side, the private equity, I guess the easiest way I could explain it, in my own opinion, I don't like it. Having been involved in financial services, as I mentioned, for a long time, the way in which historically insurance companies have managed, their assets in terms of being in the business of managing long-term risk, obviously pensions fit in there beautifully. That's why when folks like me are out talking to business owners, plan sponsors about what their options might be to manage their pension risk, private equity is going to become a bigger part of that conversation, because again, as plan sponsor, to fulfill their fiduciary responsibilities, they need to know who they're looking at and who they're working with, and just what these companies bring, good or not good, into the equation as they evaluate the best course of action for their pension plan. So it remains to be seen, as the time goes on, but there doesn't seem to be any shortage of transactions where private equity is now inserting themselves into the financial services marketplace, buying, stakes in insurance companies. They manage money, as you indicated correctly. They look at rate of return in a different fashion than a company who's in the business of a 30, 40, 50, many decades type of an investment philosophy.
Right. And I know from discussions with Marty in particular, we've been looking very closely at the Apollo-owned Athene, mostly because of the way they were created, the types of assets they hold on their balance sheet, the way they've grown so fast, and how much pension risk transfer they've done. What most people don't realize is 80% of all the liabilities are reinsured through a Bermuda affiliate that's not subject to regulation in the United States. So should something happen with that Bermuda reinsurer, that could spell big problems for policyholders. Now, one of the issues that we have had some traction with, and Karen Friedman can speak about this a little bit, is the Secure 2.0 Act has asked the Department of Labor to look into an old provision in an interpretive bulletin about what is the safest available annuity provider. In other words, how do you choose an insurance company when you're going to do a pension risk transfer deal? Now, bear in mind, as much as I'm pointing out some issues about pension risk transfer and concerns I have about the insurance industry at times, and certainly concerns I have about the intentions of the private equity industry at times, we know that pension risk transfers are here to stay. We're not trying to stop them. We just want folks to be transparent and accountable about what they do, and we want to make sure that it's money good from the standpoint of the retirees. So Karen, could you talk a little bit about the safest available annuity provider and what you see happening?
Yeah, well, the Department of Labor is doing a project on it now because they were directed to do so by Secure 2.0, which was passed back in December. And just for you guys to know, Secure 2.0 is sort of a larger retirement bill. We had a few provisions in it that we really like, this being one of them, but most of them are tax giveaways to very affluent people. Just letting you know as an aside. So, basically, the question is, what is the safest available annuity standard? It was developed a long time ago. It was developed by the Department of Labor at an earlier time. Before, there were certainly things going on in those days, as we talked about earlier, but we didn't see the trend of de-riskings in the magnitude that we do today. Just like everything, laws and regulations have to be updated based on the evolving trends, often by plan sponsors. So most of the regulatory actions involving insurer insolvency risk have centered on locating a financially superior insurer and minimizing the risk of later insurer insolvency, as Eddie mentioned. But the way the Department of Labor has dealt with this up till now is saying plans have to, companies have to select the safest available annuity provider, but it's never really clear to anybody what that means. In practice, it seems to mean, and I'm happy to get other commentators, positions on this, that an insurance company has to have a reasonably good rating from at least 2 or more insurance rating agencies. And so when, that doesn't appear to be enough. So the question is, what should the Department of Labor be doing? We have some ideas, but I think that's, I'd like a discussion among the panelists when, as we said before, when, the kinds of de-riskings we're talking about now, the big ones, Verizon and Pru, sort of did their initial de-riskings back in 2012 and 2013. I think there was a lot of attention on them. There was a lot of press attention. You had the bigger insurance companies, which I'm sure Eddie can also talk about, but, Pru and MetLife were key, and they were saying how many protections they had. But Athene, is the new big player in this. And as Eddie and Marty, well, all of you have basically talked about, we're unclear,
Right.
What backs all those, what backs them, and if they're sort of wholly owned by private equity, are they safe, right? So they're doing this not for the right reasons. And so I do think the Department of Labor is open to talking to people. So if anybody here wants to meet with them, it's a great time to do it. Our recommendations to the Department of Labor, and I'd like everybody's comments on this. One thing is that there should be a requirement that a fiduciary purchase reinsurance or negotiate a segregated reserve for the group annuity contract. And we think both of those could enhance the likelihood that the benefits assumed by the insurer will be immediately paid, even in case if there is, there are insufficient assets. The other thing that we have talked to the department, we sort of asked them a lot of questions, and we think it's appropriate for the Department of Labor, in terms of the project that they're doing, to look at the questions of relative risks between the PBGC and the state guarantee funds. And as you pointed out, Eddie, those state guarantee associations really, they're opaque. They're regulated by different state laws. They have different amounts of insurance behind them, and they're not funded, right? So they haven't been tested in any real way. So, they should be working, with the PBGC and others to sort of,
Okay. So what
look at those risks.
Karen, that's a mouthful, and I just want to break it down a little bit and go over safest annuity provider issues first, and then we'll get to the other issues about PBGC and
Okay.
state guarantee associations, because they're super important. But what I'd like to ask, if Marty's coming back, all of the panelists, I've written on behalf of Retirees for Justice to the Department of Labor and proposed some things that they might consider. And this kind of grew out of discussions that I had with various members of the department. And I just want to read you the things that I asked them to consider and get your take on whether you think they are worthwhile or not. So number one, whether or not the selected insurer is properly reserved under statutory accounting principles in all states where the insurer does business, taking into consideration the extent to which the selected insurer has taken credit for reinsurance with wholly owned captive reinsurers or affiliates that do not file annual statements in accordance with statutory accounting principles. Does that make sense to you guys? I know it does with Marty because
Yes,
we
it
talked
does.
about it, but, so the whole idea here is when companies issue these group annuity contracts, what you don't know behind the scenes is what they're doing with the assets that they're supposed to hold in reserve to cover those liabilities. And one of the tricks that certain life insurers have figured out is that they can take credit for reinsurance, hold less in assets, and substitute it with an IOU from a reinsurance company. Now, if it's an arm's length reinsurance transaction from a company that is money good, or as Karen mentioned, highly rated, that might not increase the risk that much. But if it's a wholly owned affiliate, or they're located in Bermuda or the Cayman Islands or who knows where, then what happens? How does that protect policyholders? Why shouldn't that factor into the determination of safest available annuity provider? Steve, what do you think about that?
I would have no quarrel adding that into the criteria that, you know, the insurance companies are under the interpretive ruling 95-1, which is the Department of Labor
Right.
standard, I guess, or current standard, if you will, for a fiduciary, a pension plan sponsor evaluating and finding the best available
Right.
annuity solution in that situation.
Right.
I've got no problem with it.
Okay, so I don't think anybody really would, because all you're saying is we want to be able to compare apples to apples, not
Yes.
apples to oranges. So if you're
Correct.
supposed to hold assets in reserve to cover liabilities, you shouldn't be able to move them offshore, and you shouldn't be able to transfer those obligations to a wholly owned captive insurance company located in jurisdiction light place where they're not subject to the same rules. So if everyone uses the same rules and the same numbers, you can at least know where you stand. Okay, so how about this one? Whether or not the selected insurer has segregated assets into a separate account that is managed solely for the benefit of the retirees. Now, Karen, you had alluded to that before in your comments. Is that what you were talking about, having the separate accounts for pension risk transfers? You're still muted. You're muted. Permission to unmute Karen.
It's one way to control us chatty folks.
I'm not exactly sure. Oh, she's back. Karen, you're still muted, Karen. Almost there. It's down in the corner. It's a red microphone. There you go. No, you put it back. Please give Karen permission to unmute. Okay, Karen, unmute, please. You're close. We still can't hear you. You're getting warmer. Can you unmute her? Go ahead, Karen. Still can't hear you. For some reason, your microphone's not working. I'm going to have to move on, but let me just speak quickly, and then I'll ask Marty what he thinks about this. When I first looked at the Verizon deal, I was told that the money was going into a commingled separate account. And when I was looking at this for the first time, I said, I've never heard of a commingled separate account. What does that mean? It's separate, but it's commingled? And so I managed to get the Prudential to change the wording to separate account. But guess what? It's still a commingled separate account. And if you look on the financial statements and you look at the reporting for separate account business, it's commingled. It's all of their exposure to all of their different businesses. So Marty, what do you think about that?
Well, that's a big problem. But look, if I could comment on more generally
Sure.
on this. So First of all, I-90, the guidance, we keep talking about I-95. That's the guidance that the Department of Labor put out in 1995, which, by the way, was the purpose for that was because Executive Life had sold group annuities. They didn't call them PRTs, pension risk transfers. They called them GICs, guaranteed investment contracts, and they were the PRTs of their day. And lots of employers, small employers, had bought them because they were the cheapest ones available, right? And then when the whole thing blew up, there was no mechanism to pay those people off. The state guarantee associations did not have any provisions at that time for group annuities. So, just a little bit of history. Look, what I would like to do, I think, is just, if I could, describe what is the private equity model in this industry, because it's very different from the Prudential MetLife things that we're all used to, or from the past. I think there's 4 or 5 characteristics, and it's not rocket science. The industry's acting like, oh, we can't tell them apart. You can easily tell them apart, right? 1, asset replacement. Athene, Brookfield, which is doing this now, KKR, they buy annuities. They get annuities. Either they buy a block of annuities from another company, or they get a PRT. They immediately replace the assets. What does that mean? They sell off all the liquid assets. They sell them. They sell the treasuries. They sell the corporates, or they put them up for sale, and they replace them. And they replace a portion of them with, guess what? Illiquid securities, most of which they've created themselves through their other subsidiaries. Okay? So they have created a market for their own stuff. And it means there's no arm's length transaction. They're the seller and the buyer in that transaction. So they're replacing treasuries that are liquid, that you can sell in order to raise cash, with illiquid loans, illiquid asset-backed securities, that kind of thing. That's one. Number 2, Bermuda. Eddie already talked about that. They reinsure, they create an affiliate in Bermuda, and they reinsure in Bermuda. Why Bermuda? Because they have the best laws. And that's been the case for decades. And, but also why Bermuda is because in addition to what Eddie was talking about with the way they can keep the assets, kind of not transparent, you can keep them secret, it's also true that you can hold less capital if you do this it's an accounting, I won't go into the accounting mechanics of it, but what it means is that it frees up money that they would otherwise have to hold in reserve for them to do other things with, which they did the dividends to the shareholders, or to buy more assets. Okay, so right there you're lowering reserves, you're lowering the capital cushion that's supposed to protect policyholders. Number 3, platform originations. What is that? This is what they call it. It means they are creating a place to put products that don't exist yet that they're going to create. So they bought, Apollo has bought 15 of these. Hertz, or a rental car company, they securitize all of the assets, and they sell those assets to themselves and to other insurance companies. They've convinced the NAIC, Securities Valuation Office, that those are just as safe as corporate bonds, so they can hold them on their balance sheet without extra reserves, and they can hold them forever without having to mark them down, because that's insurance accounting.
Yeah, just before you finish, I just want to point out to everybody what is so important about what you just said, and that is insurance companies are allowed to mark their assets as hold to maturity, which means they don't have to go out into the marketplace and get a real value for them. So they buy a bond, even one like Marty said, that they created themselves, and they hold it to maturity, and even if they're not getting payments, they keep it at the same value. And
nobody ever knows what it's really worth, because they're the only ones they're the buyer and the seller of that. There's no market for that product. The 4th is state regulatory capture. That speaks for itself. I think we can go into that, but the states cannot, even the states that want to regulate this don't really have the ability to do it. And the 5th, and this is very important, is they borrow short-term money. And they say that, and they don't count them as liabilities. They borrow from the Federal Home Loan Bank system. But, you know, the bailouts of the banks in the last couple of weeks, it came out in today's Wall Street Journal that they were lending, the Federal Home Loan Banks were lending heavily to these banks that failed. But guess who was the heaviest borrower?
Athene.
Athene.
No, I'm not allowed to answer.
Athene, right? So this is cheap government guaranteed money that they're using to buy their own stuff, their own illiquid bonds and securities. And they also do this in the private markets. I won't go into it, but they're called, of all things, funding agreement backed notes, whatever that is. So, but my point is that is what I think defines the private equity company model in life insurance and annuities. The problem is the other guys can't compete with that model, so they're imitating it. So now you're seeing the MetLifes and the Prudentials following what Athene and KKR and Brookfield have done, and they are now setting up their own Bermuda affiliates, or they're using other Bermuda reinsurers to get the same, to capture the same thing. So we're in a new world now, and the Department of Labor understands this. They're very frustrated. And if I can toot our own horn a little bit, it was our little union that got Senator Murphy in Connecticut to introduce the bill that ended up being that provision in Secure 2.0, and we did it because we knew the industry really wanted that bill to pass, and nobody was going to oppose it, and, you know, just because of that, right? And the only entity that lobbied against it was Athene, and they hired the former director of EBSA as their lobbyist.
Right.
Didn't work very well. Anyway,
Well,
that's
but
a long
these,
answer. I'm sorry.
no, it's a good answer, and you hit on some key issues. What they call this business when they're using these reinsurers or reinsurance with affiliates, they call it regulatory arbitrage. That's the word they give it. So they're arbing the regulators, but what they're really doing is they're arbing the pensioners. Mm-hmm. Because they're putting you more at risk. And that's what we think. I think that's where we all kind of share the same view. So one of the other areas, and I'd like to get Steve's take on this, and if Karen comes back, hers. But one of the other things I asked the Department of Labor to look at in terms of this interpretive bulletin is whether or not the selected insurer maintains an appropriate level of capital and surplus that is not dependent in any way upon conditional letters of credit, surplus notes, or circular parental guarantees. I would add to that something called credit-linked surplus notes, which I didn't even know existed until I learned about it through Athene. So what that is, those are things that you would never be able to put in your brokerage account and count as an asset. But guess what? Insurance companies can and do. They can count a guarantee from their parent as an asset. They can count a surplus note, which is a debt obligation, as an asset, and they can count letters of credit that are conditional as an asset. That's really scary in my mind, and I just don't understand how they get away with it. And I hope to do everything I can to stop it. But Steve, what do you think about putting in provisions requiring folks to maintain certain levels of capital and surplus and exclude things like conditional letters of credit, which could never include in the United States?
Right. Well, I think, first of all, the overreaching item here, enhanced disclosure and accessibility of that type of information, I think will come. When, who knows? We're dealing with enormous international financial services company. They have lobbying on their side, just like, we would or consumers would on their side. So I do believe, in my opinion, those additional disclosures and regulations that back it up will come into the marketplace. And I know, Eddie, you and I had a brief conversation about this topic recently, and I think where we're going to see more activity and an accelerated effort to get some of these additional disclosures in place is surely because of the growth in the pension risk transfer marketplace. Right. Last year was a record year. $48 billion of pension liabilities were transferred from pension plans or pension plan sponsors to group annuity providers like Met and the others that you've talked about. As that number and those numbers continue to grow, that's where the scrutiny, that's where the additional disclosure and regulation are going to follow. because of the fact that it's becoming a larger and larger part of the marketplace.
Yeah. Could you put on?
Yeah, and yeah, I would agree. I think that those additional disclosures are really important. And I'd like to add a political point here, which is, Senator Sanders now is the chair of the Help Committee. This could be a part of a great hearing, right? I think that he would, I know that he was concerned, and I think probably he reached out to you as well, Eddie, but, IBM is de-risking, and, constituents, because they were afraid that they were going to be losing benefits and all that stuff, have reached out to him. So this is on his radar screen. And I think it's really important to get it onto the screen of some of the, the big hitters in Congress to start looking at what are those disclosures. So we're not just talking about it to the Department of Labor, we're also getting it on, getting it to the press, getting it to members of Congress so that we can start having a dialogue on these issues. And I think, like everything, this is something that sounds super technical, de-risking, it's like, what does that even mean? So I think these things are going on, and then just a small group of us are talking about it, right? That are trying to protect participants, but otherwise these are just going on, and the conferences that are going on this, I mean, are mostly plans and people talking to each other about all the great ways they can dump risk, so that that they don't even care about workers and retirees and pensions. This is all about dumping risk.
So to that, would you, Austin, please put on slide number 7, which we talked about before, Karen. What Karen was just alluding to and what Steve was alluding to is the actual growth in the pension risk transfer business. These numbers have been compiled by Retirees for Justice going back to 2012 when GM did a $25 billion deal and Verizon did an $8.2 or $8.4 billion deal, depending on whose numbers you accept. But in any event, as Steve pointed out, $48 billion was done in 2022. $16 billion of that was with the IBM pension plan. And they divided that into 2 parts. $8 billion went to Prudential, $8 billion went to MetLife. That's a $16 billion deal right there. Now we're talking about real money. You got $250 billion in liabilities that have been transferred to insurance companies. And some of the issues that I pointed out, those issues, they're not something that happens overnight. It takes time, right? They don't just all of a sudden go from 0 to 250 billion, and the reinsurance doesn't happen in one deal. But what happens is the insurance companies overmatch the regulators. And in some states, if they don't object to a deal to take credit for reinsurance within 30 days, it's okay, it's approved. So you take a conglomerate the size of a Prudential or a MetLife, how can you possibly keep up with that? How do you even understand what their financials look like? So I want to show you something that's a little bit funny, I think, that I did some time ago. And this is a chart that was prepared by a good friend of mine and a good friend of Marty's, a guy by the name of Tom Gober, who's a forensic analyst. And I asked him to look at Prudential's reinsurance. And I wanted to know how much credit for reinsurance they were taking and tie it to each line of business. So I know this is somewhat confusing, but if you look at the bottom, there's a bunch of rectangles. Prudential Arizona, Prudential Arizona, Prudential Arizona, Prudential Universal Reinsurance Co., all those companies along the bottom, those are all wholly owned captive reinsurance companies. Now, Prudential, their primary regulator is the state of New Jersey, where they're domiciled. Why do they have so many captive reinsurers, and why do they have billions and billions of dollars going to those captive reinsurers? What those lines mean, what those arrows mean, is the insurance company that's writing the group annuity contract, they're swapping real assets for an IOU from their own affiliate. And guess what we don't know? We don't know anything about what's in those Arizona captives because they don't file public financial statements. So who knows how much is there now? Now, I'm sure it's not zero, but I don't know what it is, but I know that it's not disclosed. And why should any life insurance company be able to get away with this kind of hiding the salami? It just doesn't make any sense to me.
And you thought reverse mortgages were complicated.
Okay, we could put the people back up.
Wow.
So anyhow, for obvious reasons, these concerns have become real. And now that you're at the 250 billion mark, and now you're looking at more and more companies being taken over by private equity firms, I mean, it's not only Athene, and it's not only the companies that are wholly owned by private equity firms. Prudential sold $30 billion in annuity assets to a private equity firm. Most insurance companies have done deals over the past 5 years with private equity firms. So they're either gobbling up assets or gobbling up whole companies,
Yep.
but they're gobbling up the life insurance business. And the life insurance business, those are the folks who are writing the pension risk transfer contracts. And my concern is that if we don't do something now, we're going to find out when it's too late. And what we learned during the financial crisis is all this stuff is related.
Yes.
Okay, so what I think we need to do is, as Karen said, is bring this debate front and center. The Department of Labor can be helpful in certain areas, but they're powerless to do things in others. One of the challenges we have is under the McCarran-Ferguson Act, the business of insurance is relegated to the states, which means if you've already been de-risked, you got to do something to change the law at the state level. But we can also amend ERISA and show people why it's important to prevent this type of financial alchemy from taking away people's retirement. And that's what I'd like to see us focus on. What do you think about that, Marty?
I think you're absolutely right. I just think politically, and Karen I'm interested in your view on this, that may not be the easiest thing to do, but I do think you're right. That's the only way we're gonna rein it in. The states are not gonna do it. You know, and if you just look at it historically, when we get real financial reform is after the crisis. I mean, that's just the way it works, right? I mean, I was, you know, I was with the Southern Finance Project writing little reports about the S&L crisis and the banking crisis in the early 90s, and then executive life, and then, right, and there's one after another of these things, and they have common characteristics, but one thing that always happens is that the reform comes after. And can we, but this time when that happens, there's gonna be millions of pensioners, you know, wondering, what's gonna happen with my monthly check, right? And so
Absolutely.
I think Karen's right that there is great interest right now in Washington on this issue. We convinced the banking committee last year to hold hearings, right? The Teamsters and a bunch of other unions asked them to hold hearings, and they did. And they were fascinating hearings. Elizabeth Warren was fantastic. I mean, you should go to we have this website, what is it? Apollo Athene Watch or something like that.
Yeah,
I remember the name of it. But Apollo
Oh, that's
Athene Watch.
great.
And go look at Elizabeth Warren's speech on that. She's just fantastic. And there's several of the other senators were as well. So there's interest, but there's not, because of a McCarran-Ferguson, there's very little they can do other than, I believe, ERISA reform.
Right.
There is things we can do at the state level, and I don't want people to give up at the state level. I know that it's frustrating because it seems like the insurance departments, so many of them are kind of captured by the industry. But there are some states that would like to get a handle on this, and there are things. And the thing about it is, if as soon as the federal government shows an interest, then the NAIC, says, oh no, we have a problem, we'll take care of it, right? That's the cycle, and they're doing that now, which is good.
That's very good. And that is, so we have been successful at proposing state legislation and actually gotten it approved. I know Karen Ferguson even testified in Connecticut a bunch of years ago. We also got a bill passed in Virginia that took care of a couple of issues. But we very, very often run into very serious roadblocks for one reason or another. And it's usually we face a very well-capitalized lobby that says, nah, we don't really believe in disclosures. Everything's okay. You don't need to worry about it. They've got this great, well-capitalized insurer backstopping all this, and you have access to their general account. So even if you blow through all the assets, they'll still be there. Well, with all this reinsurance and with all this financial alchemy, I'm not 100% sure, but I agree. We got to take the fight to the states and to the federal government, and we got to do it simultaneously, and that's what Retirees for Justice is supposed to do. So I see that we are running out of time, and we've got a robust panel following this. So what I'd like to do is ask the audience if you have any questions that we can take to the panelists, and we'll take it from there. Yes.
Okay,
Hold on one second. We're going to have, Mahat's is going to bring you the,
this all sounds great. Problem is, as a retiree.
Hold on.
What do
Okay.
About a whole Connecticut thing. 10 years ago, I heard about Connecticut getting something and New York not being able to get anything and blah, 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 blah. It's very nice that Warren did something. I don't know if it was just a speech. I don't know if somebody went ahead and did anything. I think everybody is sick and tired, especially what's happening today, if everybody's talking about it and nothing being done.
Right.
I only get my monthly check from Prudential. How do I stop that? How do I say, oh, I'm not going to do that, if I can, which I know I can't? And then the next step is, even if I do that, even if the way, how do you get around it tax-wise? Because New York
Okay.
State does a certain thing with pensions. So that's my question. I understand all of this and I appreciate it, but I don't get what we're supposed to do.
Okay, so that's
Okay,
a
well, this is the thing. First of all, can I just say one thing on that?
please.
Look, for the most part, your pensions are going to be safe. Like, we're just talking about this sort of in a policy world and making sure that something doesn't happen. I really want to talk about what Marty said. Like, that, if an insurance company were to go bankrupt, like a huge one, or Athene because of it, then there's problems. But at the moment, if you are getting annuity from Pru, you are safe and you are getting what you're supposed to be getting. And I think it's really important to tell people that, because you don't have to worry. You do not have to worry. What we're trying to do is kind of create a grassroots media lobbying motion just to make sure that there's safeguards in place. What we want to be able to do is stop something bad from happening, right?
Right.
And what Marty said is, things are going to go swimmingly unless they don't. But for the most part, what I like to tell retirees is, in these transactions, what happens is that the pension plan transfers these assets to the insurance company. And right now, everybody is getting what they're supposed to get, and you will get that. What we're talking about is bringing the potential issues, like the fact that some of these insurance companies are backed by private equity, that there aren't enough protections in state guarantee associations to ensure that if there were a problem, that people are adequately protected. So there are two different issues. There's this sort of like, I do want to let everybody know that your pensions are safe and are likely going to be safe forever, forever and through your lives. But what we're trying to do is we're trying to ensure that this practice, as it explodes and gets bigger and bigger, that there's protections in place. So I think going the route of amending, coming up with legislation is a good one, but I also want to echo what Marty says. It's a long, long, long road to amend ERISA. It takes years sometimes to get something through. That doesn't mean we shouldn't do it. It doesn't mean that we shouldn't get the protections out there, and we should both have hit people both on the regulatory and the legislative level.
So while I agree with Karen in large part, and I do believe there's no reason to panic, a lot would have to happen for your annuity payments to be disrupted, a lot. And it would take a long time. I mean, Prudential is a $300 billion company. They're not going under tomorrow. But what I feel really strongly about is that if we don't shine a light on what's happening now, we're going to find out when it's too late to do anything about it. So that's why we need to take steps now. But to answer your question directly, what you can do is you can participate in speaking out and voicing your concerns and saying, hey, I don't want this to happen. Reassure me. Tell me I'm not going to lose my pension in 20 years. Because you're not going to lose your pension, tomorrow. You're not going to lose it next year. You're not going to lose it in 5 years, pretty much no matter what happens. Because even insurance insolvencies, I can tell you, take a long time. Executive Life of New York was in rehabilitation for 25 years. I mean, not even Charlie Sheen has been in rehabilitation for that long. So it is going to take time. There is no need to panic, but we do need to be vocal about it, and that's what you can do. Any other questions? Yes, sir. Okay, take it.
Yeah, just quick question. What role does the PBGC have once one of these transfers takes place, if any, and what impact does that have on the plan sponsors?
I'm going to let Marty answer that because I've been talking too much.
Well, it's a great question. They have not discouraged PRT transactions at all. In fact, some would argue that the way they've structured their payment, their premiums for PBG's coverage actually encourages PRT because they have a flat rate for everybody as opposed to you know, how much the liability for each, you know, in other words, the CEO of the company you're paying the same rate for that pension as you are for the, you know, the clerical workers, right, in that company. So some people think that's fueling PRT. They don't even track it, really. They track which funds are subject to PRT. These are not always terminations, right? We should explain this.
Well, let me just
Yeah.
answer the question first directly. The PBGC does not apply post de-risking. So once a defined benefit plan sponsor purchases a group annuity contract, you no longer have access to the PBGC.
But then it depletes the funds for the rest of
Right.
the plans, right? And that's why it's curious that the PBGC has not objected to this. They don't even really track it.
Right. What Marty's alluding
Well,
to.
the PBGC does, I mean, the PBGC, at least the Participant Advocates Office has done some studies as part of her
Well,
and your studies on this, being
but what
somewhat
they-
critical of it. But I agree with Eddie. Once this is transferred over, PBGC is out of the picture.
Yeah.
And that's that is one of the big issues.
Oh, that's a huge issue.
And that is right. So that's why we're saying that once the PBGC is out of the picture, if God forbid something does happen, and we're hoping it doesn't with approved, but if something were to happen, you know, then it gets down to these state guarantee associations that are not as secure as PBGC.
Well, first of all, state guarantee associations, just so we know, they are unfunded, post-insolvency assessment vehicles. And they can only assess their members based on how much premium they write in that given state. So the ability of the State Guarantee Association safety net to match the benefits that the PBGC provides is really a pipe dream.
And guess what? Almost 100% of what insurance industry assesses themselves, you're paying for anyway because it's coming out of state budgets. They get a 100% tax offset
Right.
on the assessments they pay to guarantee associations.
Right.
California lost hundreds of millions of dollars of revenue from the executive life failure.
Which I did not know.
I
until
testified
Marty
about
told
that
me. Right.
28 years ago. I was a kid, you know, or something, and nothing has changed. The other thing that you should know about the state guarantee associations is that there is no mechanism for paying lifetime benefits. That is not what they do. They were designed to pay the individual annuities that people buy as, you know, right, for a fixed annuity. So there's a limit. The limits are different in every state, right?
Right. The limits are different in every state. They range from $250,000 to $500,000 per individual per lifetime.
Yeah.
So that's when you compare to what the PBGC provides. Just so you know, for 2003, the maximum annual benefit for someone who retires at age 65 is $81,000 for a straight life annuity and $72,900 for a joint and 50% survivor annuity. That's at 65. At 75, it's $246,000 for a straight life annuity and $221,000 for a joint and 50% survivor. Now, nobody here knows how long you're going to live. But it doesn't take a rocket scientist to figure out that those lines are going to intersect pretty soon if you're comparing a lifetime cap of $250,000 to an annual benefit when the PBGC takes over. So listen, we are running out of time, so if I could take a last question, that would be great. Yes, sir.
I could tell you firsthand, having lost half my pension, that the people that are doing this stuff are no different than Sam Bankman-Fried, the FTX guy. And when they're putting money in these pockets that you can't see what's in there, that's almost guaranteed confiscation. These people that are doing it are 10 times smarter than Sam Bankman-Fried and 100 times more greedy. And I can already see the hearings. They're all wringing their hands. Nobody saw this coming, even though people like us were all complaining. I don't, Prudential's a big company who's taken over my pension. I don't feel that I'm going to see that money in 10 more years, even if it takes them, 10 years to go bankrupt. I consider these people that work, the executive of IBM, I consider them cold-blooded murderers. Because when you take away people's money that they live on, they're going to an early grave. No, hands down. That's what they are, and that's who you're dealing with. They're way smarter than Sam Bankman-Fried, and they're doing the same game with different shells.
Yeah, and
But what we want to
unfortunately,
make sure is there's regulations, legislation in place to ensure that the protections are there for people.
That's
So
right.
what I am going to offer up to you guys and maybe I'll work with Marty and Eddie on this, is to come up with messaging, strong messaging on what you could say to members of Congress and to the Department of Labor. So with a very, very, because the messaging has to be, clear, and we
Yeah.
need one or two message points. So I
So-
will happily work with you guys on this.
Thank you.
But, what we're trying to do is to put into place protections to avert any potential disasters down the line. There is far more regulation, although, as we're talking about, there's lots of loopholes, but there's far more regulation of the the pension system and these transactions that, let's say, than Bankman, of which we're thankful about. But what we're trying to do is avert those kinds of disasters and to protect people's money.
And stop kicking the can down the road, because
Right.
the challenge that this gentleman pointed out is that the people who are making the decisions about what to invest in, they know way before a policyholder knows when there's a problem, and they get their money out. And that's what kind of the purpose of what we're doing is. So thank you, Karen. We will take you up on that. Anything that we can help on Retirees for Justice, we'll get behind. And I'll take it to all the members of the Association of BellTel Retirees. And we will keep messaging and keep pushing the envelope so that we shine a light on this. I think what's important is we're not going to stop it, but we can make pension risk transfers more transparent and make the folks involved more accountable for the decisions that they make.
And this is an opportunity. The DOL is really focused on this issue right now, so now is the time to be in touch with them. So Karen, that's absolutely what's needed, is a clear message that people can send to their representatives and to the DOL.
So Marty, maybe you and I could work on that together?
Absolutely. Sure.
Okay.
Yeah,
Guys,
so let's
go ahead, Karen, finish, please.
No, that's all. I just want to say that, we should just be thinking about this because it's a complex issue. And, and without clear messaging, it kind of goes all over the place. So
I
we want to just.
completely agree, and it is very complicated. So I want to thank everybody for their time, and thank the panelists for coming in remotely and learning how to use the mute button. And are we gonna take a break, or are we gonna introduce our next?
We're going to take a very quick 3-minute break.
Let's take a 3-minute break to tee up our next panel. Don Trudeau's leading this one, so don't miss it.
Thank you, everyone.
Thank you.